Good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Tuesday, January 11th, 2022. And our top story today, the 30-year mortgage rate jumps to a 20-year high. And joining me now to discuss this and a lot more is Carl Delmont. He is the Chief Executive Officer of Freedmont Mortgage Corporation. Carl, Happy New Year. Great to see you. Thanks so much for joining us on the program this morning.
Happy New Year to you as well, and look forward to being here.
Yeah, we turn the page. Hopefully, new year, no COVID. Well, we'll see how that goes. Carl, the world's coming to an end. Mortgage rates are going up. I wanted to get your thoughts about this because, according to Freddie Mac, I think the 30-year mortgage has now gone up above 3.22% and it's historic in that it's been the highest that it's been since in 20 years. Is this the end of the world?
Yeah, actually 20 months.
20 months, I'm sorry.
Yeah, the highest in 20 months. But, when you put things in perspective, it's really not that ominous because here's what's going on. If you look at where rates are today, even though they are up, we're still lower than we were pre-pandemic. So that's good news. Bad news, looks like rates are probably continuing to move up a little bit more simply because jobs, the employment outlook looks fairly good as far as full employment, or at least close to it. The Fed's signaling 3 rate hikes in 2022. I'm sorry. Goldman Sachs just came out and said they think it might be 4. So, when you look at rates where they are today, historically, still really, really good. I always make the comparison that, people always lament over, oh man, look at gas prices. It's whatever, $2.90 a gallon. Well, a few years ago, it was $4 a gallon. A couple of years ago, it was $1 something a gallon. It goes up, it goes down. But again, when you look at things in historical context, rates are still very competitive.
Yeah, and I grew up in the 80s. I think clearly we remember the 80s, high interest rates, the late 70s. I mean, there's a lot that goes on economically. We go through different tightening, different cycles. We appear to be going through that now. Obviously, you mentioned inflation being a big challenge. The Fed's trying to adapt to that. In terms of what your expectations are for your own business and mortgages, do you think this slows down people buying homes, at least initially? Or, if you think back to the 80s and 70s where you had double-digit interest rates, I mean, it's still a good time to buy.
Yeah, again, but psychologically, people don't even remember what the lowest was, right? So they think, oh, wow, I missed out. You really haven't missed out yet. But, do I think it's a good time? Yeah, I mean, again, we've talked about this a million times. If you're emotionally and financially ready, now's a great time to do it. Survey just came out. I was reading this the other day, and it's pretty interesting. About 56% of would-be home buyers feel urgency to purchase now because they're worried about rising rates. Not necessarily a great thing because now you're putting an emotional aspect into a financial decision. But, again, it becomes the fear of missing out, right? FOMO. But I think also when you're looking at it, there's some people who think that maybe this is a good thing. Maybe this will quell some of the demand and maybe home prices will stabilize and maybe the competition won't be as much. But most economists and most surveys are saying that this is going to be another pretty strong year for housing.
Carl, when rates go up, what's the difference between a 10% increase in rates? So, for example, you go to 3.22 from 3.12%. What does that translate if you're buying a home for, say, $500,000? I'm not asking you to you don't have to do the exact math, but I mean, what does it mean for a payment? I mean, is it so material that your payment goes up $100, $200, $300 a month?
So I've always said this, look, if your payment's going to change on, say, you said 500,000. Let's use maybe 350 for more of an entry level price. If your payment's going to go up $100 a month and that's going to cause you financial stress, then I think you better sit down and really look at your budget and find out, is home buying offer, for you? Because think about it, you could lock in a 30-year fixed rate, right? And then 3 years from now, your property taxes go up $3,000 a year. Your homeowner's insurance goes up $1,000 a year. If you're worried about oh wow, I missed out because rates were X and now they're a little bit higher. Now my payment's $75 a month more. I mean, that could be anything. It could be your utility bill, could be what your monthly budget is for gas just to drive to and from work, right? So if you're really worried about that, then I think you really have to think is now a really good time for you to be a homeowner because again, when you rent, everything's pushed on the landlord, right? You know that you signed a long-term lease, nothing's really going to happen. But when you own, everything's on you. So you really have to have that extra money in there. Just, again, have that peace of mind knowing that there could be some increases.
Yeah, and I want to just hit on the budgeting aspect of this. There might be a lot of first-time buyers out there, or maybe home buyers who are ready, who have had their home for a long time. They're looking to move to a new area. You mentioned some of the budget items, but how do you kind of look at that, break that down over the course of a year? Do you break it down and say, just for 1 year? Do you look at a 5-year pro forma? How do you kind of figure out if you're ready to make that purchase? You're ready to get rid of your old home, move into a new home?
Yeah, I mean, I think every situation's different, but for a rule of thumb, I think what you look at is, can you afford a new payment? Is it going to offer you different things? Because there's some intangibles there too, right? If you're selling your first house and buying another one, maybe it's a bigger house. So ostensibly you're going to have a higher payment. But is your family growing? Is it closer to work? Maybe it's further from work, but you're working from home now. So there's all those other intangibles that go along with it. But I would tell people, look, sit down, look again on paper, what are you comfortable with, what income and outgo, and then figure out, are you able to still to put away that, they used to say 6 months of reserves, right now it's 9 months. Put away those reserves, and then again figure out, your utilities can go up, your taxes will go up, your insurance, all those other things that go up. So just make sure there's a cushion there as well. But you really don't want to be house poor. Back, reference what we said earlier, back in the 80s, people are just like, what, I'm sure we'll make it work, we'll just roll the dice, buy the house, and we'll make it. And people made it work, right? But then again, what was the average home price? 50, 60,000. So now granted rates are 16%, but now the average home price is 300,000. The mortgage rates are what? One fifth of that. So, I mean, when you look at these things, everything's different. Our property taxes today are probably what our parents paid, for 10 years. When we were growing up. So, I mean, all those other factors go in and make, affordability. And that's the one thing, as rates go up, affordability is a big question now, because, when you look at rising home prices and then potentially rising interest rates, will income rises quickly? So that's, again, it's very, very important to sit down and figure out with your significant other, whoever you're buying a house with, and just make sure, okay, look, here's everything that's going to happen. Are we good with this? And this is where a competent loan officer and realtor is going to come in handy, because they'll be honest with you and tell you what's actually going on and what to possibly expect, and help you with the question you asked about budgeting.
Yeah. Let me ask you about this. You made reference to it. Taxes, property taxes. Are we to expect, inflation itself is a tax. It's a tax passed on to the consumer. It's a tax our friends in Congress don't actually get to levy on us, but it's levied in a different way. But are we to expect that local property taxes are going to go up significantly? I would imagine that during the pandemic, or I know during the pandemic, a lot of local budgets were hit hard. This is a way for them to make back some of that revenue so they can provide vital services, police, firefighter, sanitation, all the things that government tends to do at the state and local level.
Yeah, I mean, there's two thoughts here, because if prices have risen dramatically, and some studies say that we saw 19% increases nationwide last year, do they have to increase taxes? No, they can tax you on a new higher value, and they still have more revenue coming in, right? In Maryland, where I'm at, it's interesting. Maryland has a very, very unique way they handle property taxes. And actually other states and even other countries come in and study it. What Maryland does is divides a state into thirds. And then every 3 years, that third, they get the assessment. So it gives you a little bit of a budgeting thing, because that you're pretty much protected for 3 years, assuming you come in the same year, right? If you buy in the second year in that district, that's and go into the third year, you only have 1 year. But case in point, the next year, you got 3 years locked in, right? So that's a good thing. But yeah, I mean, I would see that the cost of goods, everything else, services going up. I could see maybe them raising the mill rate in some areas.
Yeah, I just don't foresee taxes going down. I think the rule of thumb in retirement planning is know that taxes are probably going to go up. You're going to be in a higher tax bracket, so you need to be prepared for that. And buying a home seems to be very similar to that in that respect.
Absolutely. And then with the repeal of SALT, that made it a little bit different too, because a lot of people are like, oh, I don't care. My taxes are 15, 20,000 a year. I get to write it off. That's changed a little bit now. But what's interesting on a segue for this is that FHFA, which oversees Fannie and Freddie, they've come out now and said that loans delivered after April 1st, if it's a second home, they're going to actually increase their fees on that particular loan product. So if you're thinking of buying a second home, not to rush into it, but something to think about. If you think, we're going to buy in the next few months, you might want to accelerate that process just a little bit because you'll save yourself quite a bit of money.
Yeah, it's a complex decision. Carl, I need to take a very quick break, and we come back. Has the mortgage industry already priced in these rate increases? We'll talk to Carl about this and a lot more. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you over 50? Would you like to get up to 33% more income in retirement? Then call now for this free book, Annuity Do's and Don'ts for Baby Boomers. This free book reveals little-known secrets about annuity strategies that will help you make the right choices before buying an annuity. Call right now for your free book, and as a bonus, we'll also throw in a free annuity rate report, both absolutely free for calling Annuity General today.
Call 800-504-8194.
Welcome back. We're talking this morning to Carl Delmont of the Freedmont Mortgage Corporation. Carl, thanks so much for sticking with us this morning. Appreciate having you on as always.
I appreciate being here. Thank you.
Yeah, it's fun. So we talked about the rise in the 30-year mortgage, the highest in 20 months, just a point of clarity. Let's talk about the mortgage industry, and you're part of that industry. Have you and your peers priced in these interest rate increases that we're supposed to see? You mentioned Goldman said 4. I think the most people,
signal 3.
Yeah, they signal 3. But I mean, have you guys priced it all in already?
So, when we look at mortgage rates, mortgage-backed securities are really what dictate mortgage rates for everybody. So as a mortgage lender, we're not raising rates. We're taking what the mortgage rates are, as far as based on mortgage-backed securities. A lot of people say it's a 10-year treasury. To me, that's like comparing unusual meat at a restaurant. What did it taste like? Chicken. It probably didn't. It's just the only benchmark you have. The 10-year treasury is a good guide, but mortgage-backed securities are much better. And yeah, you're seeing the 10-year treasury and mortgage-backed securities. Investors are already pricing in a number of rate increases. But again, and that's why we've seen rates move up. The trick here is going to be, what's the Fed going to do? Are they, we know they're going to raise rates, but are they going to raise rates before they finish tapering? Are they going to minimize tapering and focus more on a rate raising? Powell and company have a very, very daunting task ahead of them. I mean, when you look at inflation, it's going to run hot for a while, but I think it's like anything else. I always make the analogy, soap operas when we were young, they always invented a weather machine, right? Well, when the Fed invented this artificial stimulus, it created really the same thing as, a weather machine. If people in Florida want snow for Christmas and someone invented that, that's going to change things for the whole climate for a while as well. And I think that's what's happening now. The Fed had to come in and do some things during the pandemic, and now it's time to pay the piper. And, the supply side issues and everything else that's going on have all contributed. There's just a number of factors, but to, red hot inflation. And, transitory was the term for a while. Now most people think we're going to see this for about a year or so. They're even calling for, lower revisions on GDP and everything else. But it's interesting when you looked at the jobs report this past Friday, headline number wasn't phenomenal, but when you're looking at the employment number, we're getting close to full employment. But what's interesting is if you delve down deep, like U6 dropped a little bit, which is actually probably a more accurate way of looking at the jobs numbers. But there's really sort of two different type of survey models going on, one with businesses, one with households. And I think what we're seeing now is a vast number of people who either were forced to or wanted to, and they're becoming self-employed. So I think that's skewing the numbers just a little bit, but they are contributing to the economy. They are paying taxes, but they're maybe counted a little bit differently. But, the great resignation, like what are people doing? Like if we're in a weird economy, why are you quitting? And I think this is why people see opportunities where I kind of like working from home, or, what, this little side job I was doing is kind of nice, and I think I can make good money on it. And I think there's, a lot of people, boomers, hate to use that term because it sounds derogatory, but, I'm in that category. They're retiring earlier than normal. I mean, I have friends who are retiring in their 50s right now because they invested well and did some other things, which 10 years ago, I don't know that people in our age group would have said, hey, you know what, I'm going to retire at 55, 56 years old. But I think they've done well with real estate. They've done well with investing. And I think a lot of people are just like, you know what, I don't want to come to work every day. I kind of want to be semi-retired. And I think that's changing the economy a lot.
Yeah. And I agree with you. And by the way, I don't think boomer is a derogatory word at all. I think that is it's very a good word. The boomers have done great things for America. Let's talk about things that you need to think about. You hit on some of this in the first segment, but if you're getting ready to get a mortgage, I want to remind people credit score. Let's talk about credit score, the credit application. Let's talk about some of the fees. Would you expect? Let's start with fees, though. Would you expect fees to go up as rates increase?
You could. I mean, you could see some lenders that are seeing demand drop and their volume drop, that maybe they might try to make up for that revenue by increasing some fees. So you definitely want to shop around. You want to, talk to your lender. I've heard of people who, they get called and they're like, hey, we could take your credit card. We're taking an application fee. We'll lock you in. Here's the rate. And then you find out after you paid the application fee that it was a fixed rate and it was a 30-year term, but it wasn't fixed for 30 years. And you're like, wait a minute, that's not that great a deal. I'm paying 2 points to get, an adjustable rate mortgage. So you really want to make sure, don't commit to anything. Don't pay any money up front, get it in writing, and then, ask around, make sure that, because I do think there's some lenders that'll probably do that. Again, I think it'll be attrition too, because there are a lot of lenders out there that are what we call refi shops, where they just buy leads and try to, get people to refinance. As rates go up, that sort of nullifies a big chunk of that market, right? So, although I did see a study a couple of weeks ago, said about 75% of people still have rates higher than today's rate, and even rates that would be a quarter point higher. Now, obviously, we're probably at that point now with rates because this article is about 3 weeks old. But bottom line is, if there's that many people, 75% of households that could actually refinance and benefit, maybe there will be a little bit of that market left. But for us, we're focusing, as always, on purchases, because that's always going to be there. And that's a big driver of the economy. I always say that if the economy was a twin engine jet, housing and jobs would be the two major components driving it.
Yeah, it's a very good analogy. Carl, let's refocus back on credit score, income. You talked about people maybe leaving their jobs, the great resignation. Maybe they're just doing something else. Maybe they got bored doing what they were doing and wanted to start a new vocation. What does that mean towards meeting those income requirements for getting the best mortgage rate possible?
Now, see, this is a great question, because here's what you're going to see coming up with a lot of lenders, including us. non-QM mortgages, non-qualified mortgages. So those are mortgages that are going to cater more towards self-employed, people a little bit harder to prove income. Rates will be a tad higher because of the inherent risk priced in, but I think you're going to see a rise in the non-QM sector. You'll see a lot of lenders start marketing that because that's going to be another niche segment. Just again, to what we talked about and what you just mentioned, a lot of people self-employed, a lot of people who are maybe have a second job, whether it's I hate to say Uber or any of those other things, but sort of the gig economy. But yeah, as far as rates and everything else, when you look at fees and everything, I don't know. I think you might see the opposite. I think you might see lenders get real competitive and start cutting prices and doing other things to try to take market share from others. But it remains to be seen what's going to happen out there. Again, I think there'll be some attrition in the mortgage world. The strong will survive as always. But as far as consumers, I think seniors are going to be happy because they're going to see their savings accounts start paying them more money, right? But I think others who have anything, if you have anything tied to a credit card, a home equity line, anything tied to prime, be prepared for increases. We talked at the beginning of the segment about if $7,500 a month is going to scare you off from buying a house. Well, if you have a home equity line, you could see your payments go up even more rapidly because of those increases the Fed's going to put in place soon.
Last question, Carl. Elasticity in the housing market. This has been an issue. We've been lacking supply. A lot of that is due to supply chain issues. It's difficult to get workers. Where do you kind of see that in 2022? Interest rate rise. Does some of this cut off people buying homes? Maybe it creates a little bit more elasticity, or do you see more homes being built?
Well, I think builders are trying to build more homes and try to keep up with demand. But again, when you look back at probably the early 2000s, we had a lot of the environmental issues, and they created buffer spaces. And instead of building one house per acre, now it's one house per 3 acres, and you got to allocate 30% of the land towards this and that. It makes it tougher and it makes it more expensive. But as far as inventory, again, I think we'll see a small increase, not significant enough, but we have a lot of loans still tied up from the Great Recession in judicial states. Maybe some of those houses will come to market. You look at some of the mortgage forbearance that's ending now, so that may create some homes coming on the market. But again, I think it's going to be everything else. If you're going to purchase a house, you want to arm yourself and position yourself as the best candidate. Think of it as a job interview, and there's 40 other people trying out for the same job. What separates you? So what you want to do is you want to make sure that you have everything ready to go. You want to make sure that you have a solid pre-approval from a local trusted lender, and you want to make sure that you understand, hey, if I have to offer a little bit more, in your mind, understand, hey, can I afford another $50, $75, $100 a month? Don't offer that right away, but if you have to come back and counter, at least you're not making a rash decision. You've already got it priced in. But I think 2022 is going to be a good year for housing. There'll be some hurdles. There'll be some concerns and everything else, but I think overall it'll be another healthy year when it comes to the end numbers.
Well, I hope you're right. Fingers are crossed. And we're going to check in with you, Carl, throughout the year. Carl Delmont, pleasure chatting with you. Thanks so much for joining us. And we look forward to having you back on the program again very soon.
Appreciate it. Happy New Year to you.
And that wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in lifestyle, wellness, finance, tech, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to see our latest content or search our archives? Check out our streaming partners, Amazon, Roku, Samsung, and over 100 more. We're back again tomorrow. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
But if you're tired of the same old
Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.